Welcome back to Vantage. This is the first one after the UK budget and since the Trump election win. We thought we'd focus on a UK fund manager. He is one of the top performing small cap fund managers and get his take on the world out there and how he's making money. Let's go take a look. Welcome back to Vantage. I am delighted to be revisited by an old friend of Edison's. Laurence, welcome back to Vantage. We last had you on here in May 2023, which sounds like a long time ago. It's not, but you'd shortly IPO'd the fund. It was at really interesting times. It was quite challenging IPOing a fund at that time, but you made it. Really great to see the progress that you've made over the course of the last year or so. To start off with, just remind people of what Onward Opportunities is aiming to do, its size, and where it's listed.
Well, morning, Neil, and glad to sort of come back with the sun just about shining again and a smile on our faces. Onward Opportunities is effectively a fund. It's focused on the UK, on special situations within the UK, really looking for value that can be created through change in a business, in a share. If sort of keener listeners go on our website or look at our fact sheets, they'll see a little snow leopard in the logo and some of the branding. And snow leopards are crepuscular as an animal. That means they're active at kind of dawn and dusk. And that's really how we think as investors. We try to find something first, and we've got some examples of those later, or a kind of dawn type mentality or dusk. And that's really going in, everyone's given up, end of the day type, overlooked value and trying to extract or salvage some of that. The fund itself is a listed company. So listeners, shareholders can buy and sell shares in the fund on the London Stock Exchange. All you need is a sort of, Hargreaves Lansdown type app or otherwise. And I think that's one of the great qualities of not just investment companies, investment trusts, but actually public markets. They're accessible. Anyone within reason can sort of buy and sell a share in a listed company. And I think, there's a lot of talk, it has been for a while now, about the challenges public markets are facing and the importance of them. But I think one importance that's probably not recognised enough or championed enough is there's a public good argument for public markets. Mm-hmm. It's a way, the famous Warren Buffett quote, there's two ways you get wealthy. You either build a great business or own a share in one. Well, you have to be a sophisticated investor to really access a kind of private deal or a private equity fund, and the minimum investment, usually quite a lot of money. Whereas public markets is the chance for the ordinary investor, the ordinary person, to do something sensible and try and appreciate capital. And so it was important to me that we Onward itself was accessible, and we've structured it in that way.
Okay, and the fund's done really well since you've launched it. Yes, fingers crossed, etc. But I regularly see you in the sort of top 3, top 5 of performance within the asset class that the people benchmark you against. What do you put behind the sort of strong performance?
Well, first and foremost, some really great hard-working management teams in the portfolio that are delivering outcomes for shareholders, of which we're one, delivering change in their business that's leading to appreciation in share price, kind of in spite of the way the wind and rain is blowing outside at the moment in the UK economy. And I'm sure we'll probably talk about that a little bit more later. Mm-hmm. We've really... Onward Opportunities, as I said, is a fund. It has a strategy like any fund would. Ours is quite high touch, and that allows us to really, I sort of call it gems amongst the rubble. UK equity markets are challenged, as I hinted to a moment ago. That's the kind of rubble part of the sentence. They've allowed themselves to slightly blow themselves apart, self-inflicted, and other people lobbing in hand grenades as well. But amongst that, there's some fantastic businesses at fantastic prices, and that's really what we've been capturing and driving the kind of absolute and relative returns. I think looking this morning, the fund, the net asset value, the performance of the fund is up about 28% from launch 18 months ago.
Yeah, no, really well done. And I mean, I know the sort of challenges of working with markets, which is that, suddenly after years and years, you saw fund flow coming back into the UK market only for a short time. And then, they suddenly started reversing on the back of speculation of what Rachel Reeves was going to do on the capital gains tax side, etc. And it does lead to volatility in the markets. Just want to understand a little bit about the strategy of, how do you mitigate the impact of volatility and risk for the fund?
Look, we're long-term investors and we're very stock specific. That high-touch strategy I've mentioned means we're quite concentrated. We tend to own 20 great ideas rather than 100 or 200.
Yeah.
And we tend to identify what we think are 20 good ideas for 3 to 5 years plus. So the direction of travel is fairly consistent and a long-term mindset. The motorway is going one way, but sometimes we might change lane within that and get in the slow lane or the middle lane rather than the fast lane. I think what I mean by that is we will sort of try and pick our timing with investments. Of course we will.
Yeah.
And we won't just blindly allocate capital without checking what the weather's like outside. A good recent example, we were sort of fully invested in the summer, so cash was less than 5%. The election happened. Our investment committee quite quickly got together to talk about the impacts of that election, so looking at what the weather's like outside. And one of the conclusions was that AIM-IHT would very likely, the inheritance tax break for AIM shares would come under the microscope. And that speculation that you've talked about would impact shares of stocks that had a lot of inheritance tax type owners. And we identified 2 stocks in the portfolio that were vulnerable. We sold them within a week, locked in good profits on both, and both were down more than 30% by the time of the budget from where we sold. So it was definitely the shrewd thing to do. That gave us a bit of cash. And then we have been growing, as you mentioned, and we raised money twice in the third quarter before the budget. And that cash we raised combined with the proceeds of the sales meant we did go into the budget period with about 18, 19% cash. Mm-hmm. But by the day of the budget, we were kind of fully invested again. Okay. So there's definitely shimmying and tactics, but really just picking our moment more than anything.
Okay. When I looked at the sort of Q3 fact sheet, there were some standout performers in that, and I think I always like sort of getting into the substance of the portfolio because I think it brings the stories to life. So to 2 which I picked out, Transense Technologies and Windward. Just give me the elevator pitch, effectively, of why you're an owner of these, what gives you conviction, and what further growth potential you see in them.
So Windward is a genuine AI play, as in it has a micro application, very specific in marine traffic, really helping governments and companies avoid sanction breaches and monitor those and protect borders.
Yeah.
Sadly, very topical, and will continue to be. Just look at the headlines this week with the Chinese trawler cutting through those undersea cables. It's the fastest growing tech business on AIM.
Yeah.
And those revenues it's growing, I think it's about sort of 35% plus at the moment, are 80% gross margin, which is now mean the business has just hit break even. And we were able to buy that very short elevator condensed version of what we bought for 1.5 times sales, gem amongst the rubble. Exciting business. Usually we don't get the chance to own a business like that because they're usually too expensive for us. 1.5 times sales compared to transactions for these kind of businesses at maturity is 5 to 10 times.
Yes. Yeah.
You won't find many AIM stocks for General David Petraeus as a shareholder. Windward is one. So it's a fascinating company. Some of the insights on marine traffic they published, like yesterday around this
Chinese
trawler, it's just, for me, it's just nice to own a business where I'm genuinely fascinated by what they do. And then Transense Technologies is a business of 3 technologies, 3 components. One has already been sold off on a royalty, and actually we were able to invest at a discount to the value of that royalty. So you were buying sort of £10 tomorrow at £8 today, so a bit of margin of safety.
Yeah.
And I mentioned there were 3 technologies, so if we bought in at a discount to what this one's kind of worth, you got these 2 for free. You weren't paying any sort of goodwill for them. And actually we discovered that, they're both really good components in their own right. Translogic is a tire pressure and tread depth monitor, which sort of by accident has ended up being used by the 6 out of the 10 tyre majors. And the new management team, I talked about change earlier, the new management team has sort of spotted this, and there's a real chance to grow that. And it's a 60% plus gross margin product. And then the real sort of potential golden goose is the third component, which, look, it's not a slam dunk. We haven't paid anything for it. So we're at sort of ATP in a pound. So we're not fussed, but we'd love it to succeed because the potential's almost limitless. And I say that because it, again, will be a royalty business. It has a patented technology for measuring torque, heat, and pressure using sound waves. There are a number of benefits to using sound waves rather than magnetism or kinetic movement, which are the two alternatives. The magnetism one's particularly interesting because that's been the preferred style until now. But of course, electric motors generate electromagnetic interference, so they kind of aren't applicable. And what's really interesting is since we've invested, they've started to put meat on the bones. And what I mean by that is they've won their first automotive contract with a business called Protean, which with some help from the UK government is designing in-wheel motors for electric vehicles. Yeah. They're going to measure the torque. And then Airbus, which is probably a business people will have heard of, they're working through a sort of trial experimental project with them on their next generation of landing gear. And there's 4 or 5 verticals where this torque application can apply. And because it's a designed-in component with a royalty and some sort of non-recurring engineering revenues initially, the margins there are kind of 80-90% gross and very sticky. Because if you think, if Airbus design you into a landing gear or Protean put you in a wheel motor, you're literally designed in. Yeah. So unless they tear up and go again, it's quite long-term. That does mean it takes time, and Transense has been around a while trying to do this sort of thing I've described. But what's, I mentioned earlier, change, okay? New management team with a new approach came in 2019, and they've got the business succeeding. What do I mean by that? Profitable, throwing off cash, now winning exciting customers and putting their money where their mouth is. That the management team have been consistently buying shares. That's one of the things we spotted because it wasn't the simplest business to model and understand. And it's the kind of sort of wide range of outcomes that are hard to value. But seeing management put proper money where their mouth was and talking to customers like McLaren who have used the component for things like IndyCar seems to have a business that's really got motoring, if you sort of slightly pardon the pun, after 20 odd years of trying.
Yeah, no, it's good. And it's nice. It's really nice to see these sort of success stories on the sort of junior market. Before I get into, I also sort of noted a couple of additions to your sort of core holdings. But just before I get into that, just explain to people the concept of your nursery and core holdings for the fund.
Very happy to. So the nursery is really about a quarter to a third of the portfolio, and there's usually about 10 of them in the portfolio. So doing some simple maths, listeners, about 1 to 2% of NAV is invested in them, so 1 to 2% of the portfolio. And they're called the nursery because these are emerging, nascent ideas. Yeah. Typically, they're ideas we're looking at as a potential core investment, and I'll come back to what that means in a minute. And we've done some initial work, probably the level of work a traditional fund manager trying to own 100 stocks would do. And we think we spotted value. We think there's catalysts. It's credible. And we see upside. And we just started to capture a little piece of that for our investors. And the reason we do that is twofold. Our process takes time. I mentioned we were high-touch investors earlier. That means sometimes you miss the boat. And by that, we've had examples where things have been bid for while we're doing the work, and that's pretty soul-destroying. We had that with DX Group at the very start of Onward, which we were about to take to our investment committee bid lead, but luckily it was in the nursery, so we still got some upside. Yeah. Our process takes time, and also just sometimes the market, it's a public market, what we were talking about earlier. There's other much smarter people than us out there looking at these stocks too, and sometimes they start recognizing the value and you miss the share price appreciation. The DX Group example is a good one of why we do it. The core of the portfolio is really, really fully qualified in-depth ideas where we take a much larger weighting and position, and we've spent the time and done the work to build the conviction to warrant that kind of commitment. Those investments have to be approved by our investment committee, which are, four experienced, wise heads that have got a real diversity of background and skill sets to support the day-to-day fund management team on making, picking out the good investments, the great investments from the good, and weighting them accordingly. And then sometimes maybe avoiding ones where we might have overlooked some risk areas, or people have seen similar examples before and they're not as supportive. And they tend to be about 4 to 8, 9% of the fund at cost.
Yeah. Okay. So you added to the core Alumasc, which, on the surface of it might not look particularly exciting, but actually it's got some really interesting sort of potential to it. And the mission group as well was sort of added on. Explain the thesis for those two and why they were good fits for the portfolio.
So one look at the tragic events in Valencia a couple of weeks ago is why Alumasc really is sadly exciting.
Yeah.
That's because Alumasc has 3 sort of divisions. It's a building products company, and the largest and really the strongest is a water and drainage division. Alumasc owns 3 of the best-known drainage building product brands in the world: Gatik, Wade, and Harmer. You ask any builder who knows their onions, and they'll have heard of them. They've been around a long time. That's why they throw off 15% plus margins. That's why the business is growing in a kind of downtrend for construction, and it's why they're able to pass on all the build costs inflation of the past few years. Those brands are a strategic asset in a structural growth market. Water's particularly interesting because if you get the drainage wrong, the whole building's a bit kaput. So brands are probably more important here than, say, in a more commoditized part of the construction building products market. And that's why, for example, these Gatik gas and airtight covered drains they produce, which are bigger than this room, people will ship those half around the world. In the current example to Hong Kong airport, where they're using them to build that out, that ain't cheap. So that's telling you there's something here that people are prepared to find and ship over and bear the cost. We think those brands, someone like an East Jordan in the US or Wienerberger in Europe or even Genuit at home, would see those as kind of assets to cover over time. And Alumasc were trading on 3.5, 4 times EBITDA when we started looking at it. Wrong price, arbitrage.
Yeah.
The other attractive part of Alumasc is its currently smallest division by revenue, which is Timlock Homes. I couldn't quite believe it at first. Timlock injection mold manufactures its own designed building products for around the home. This time it's really focused on kind of ventilation, so more air rather than water, but it's throwing off last year 23% operating margin, which I thought was kind of full.
Yeah.
And then Michael, Paul and the team have gone and done 26% this year and grown in what's been undeniably a tough market for house building.
Yeah.
So again, there's clearly a product here that commands a margin, can grow and win market share. And we'd like to think and promise at some point kind of there'll be a bit of a bull market in kind of construction, infrastructure, and they've been growing in a down market. So by that share they've got in an up market, there's a kind of immediate upgrade from that. But we think they can go on and take further market share.
Okay. And the other company which we touched on, which is
the Mission Group. Mission Group's a classic special situation. It's an advertising agency, not a typical stomping ground for us. Although when I worked on Rockwood Strategic with Richard Staveley, we did M&C Saatchi, which had some similarities to what we're about to describe, and we made really healthy returns. Advertising cycle slowed down. That meant profits went down at the Mission Group. They had built up some debt, so we were acquiring other businesses. Debt now looks big in the context of lower earnings. Can they pay it off? Shares down quite a lot. In fact, to a P of about 3. If you just ignore the debt for a minute, and the reason why we ignore the debt is that as the crisis unfolded, the former chief executive, a chap called David Morgan, He owns about 5% of the company, so very aligned with shareholders, has returned as chair to sort it out. And by sort it out, they have a clear, publicly stated strategy to dispose of some of the things they bought.
Yeah.
And we estimate they'll probably dispose of one or two agencies that are worth roughly what the debt is. That will wipe out the debt. It shouldn't trade on 3 times PE, it should trade on 6 if there's no debt. So it's a quick, so 2-timer in sort of 12 months there. And actually, it's got some really great customers itself, but it's a special situation. That's why we're invested. And obviously, usually one of the drawbacks of a disposal is you get money today, but you lose earnings tomorrow plus one.
Yeah.
But here, we estimate, backing out some simplistic multiples, the earnings they lose from a disposal, they'll get the majority, if not all that money, back in a zeroed interest line.
Yeah.
So at the PAT level, it's neutral. So it's you can see how you get a kind of quite dramatic swing from basically enterprise value to equity value.
Yeah.
And all eyes on the management team executing that strategy.
Okay. Now we touched on the budget, and one of the things that you stated that there's a target of trying to generate at least a 15% return annually. If I look at what the OBR is talking about, if I look at what either the fund management community focused on the UK or sort of general economic commentary on the UK, I would describe the growth outlook as patchy at best. I mean, it's challenging out there. And we see it in the way companies are sort of addressing and positioning themselves for the years ahead, which is, they are getting on with it, but it's with some caution. How do you sort of focus on getting to that target with that kind of backdrop?
Look, I've been really fortunate in that I spent 9 years or so at Gresham House really being drilled and then taking part in delivering those kind of returns through the cycle. Mm-hmm. That's the track record of many of my former colleagues. It's been the track record of Onward Opportunities, more importantly, to date. I mentioned earlier the NAV is up about 28% as we sit here today. Yeah. In 18 months. That's slightly ahead, in fact, of 15% per annum. And it's, sadly, the macro, the weather outside has probably got a little bit worse since the budget, when everyone's hoping it might, clouds might part a bit. But it wasn't great before either. So so far so good. We've been able to show we can hold our own and deliver that return target slightly irrespective of what way the wind's blowing within reason.
Yeah.
And that's because of the way we invest. We look for change going in the business, and it isn't change that's reliant on what politicians do, because if there's one thing that's impossible to model, it's a politician. They change their mind, they flip-flop, they lie, everything. So, for example, if MPAC does a buyout for its pension surplus, that will drive, a better multiple for the shares. That's going to happen slightly regardless of what HREs does within reason. Or in the case of Alumasc, they're showing they can win market share in a down market. So they actually beat one of the few construction firms to have beaten forecasts this year, or Windward rolling out a new AI module that wins some new clients. That's going to happen anyway. Perhaps you don't get as much upside as you might in a bull market for equities, and all that's telling us is that it quietly, whisper it, bodes well for our strategy when things are a little bit, more benign. But we're just going to focus on backing the teams we've chosen to back, helping where we can. You won't probably see us on the board ourselves. We're busy doing the fund management. But you might see people we know or from our network or people we recommend helping the companies in the wings or on the board. But really, we're going to stick to the knitting.
I love that. Look, there's a sort of sense of belief in what you're doing. There's sort of, the confidence that, look, I've been trained to do this. I know how to go out delivering it, etc. And no excuses. This is whatever the environment, we know what we're looking for. That we describe as conviction, right? And I just wanted to use that to talk about the sort of balance between sort of conviction and diversification. So you are, let's describe it as a concentrated portfolio.
20, 22 holdings, etc., versus others who are holding 100, etc. What is the philosophy there?
The first philosophy is I don't think there's 100 companies I'd want to own. So, I mean, I'm joking. Look, just the way my mind works, I would far rather try and know everything I can about the risks and rewards of 20, 25 ideas than try and keep tabs on 100. I mean, it's the kind of the dog walker with 2 dogs or 10. It's just chaos, isn't it?
Yeah.
I have quite a kind of directional process of thought. I can really throw myself into specific things, and that presses my buttons, and I enjoy it. And really, we're high conviction investors, but it's backed up with work and understanding. And then the crucial bit is that gating with the investment committee, because you have to really be sure. You're not always right, even when you're really sure.
Yeah.
You sort of picked up on a level of conviction in the portfolio. Look, I love to say it's because we've got a crystal ball, and we've been doing this 25 years and yada yada. It's not. What it is the same reasons that are making equity markets a bit difficult at the moment. They also mean that the good equities are really, really cheap.
Yeah. So
actually, Alumasc should never have been on 3.5, 4 times EBITDA, or Windward should never have been on 1.5 times sales. And sort of slightly counterintuitively, the reasons why it's tough are also the reasons why it can be good.
Yeah. It's going to draw attention. You keep doing it, it'll draw capital, will follow through, etc., because you're spotting opportunities that currently people aren't necessarily picking up. You mentioned MPAC, and I can understand the reason why you increased your position there. I think the other one, which I noticed that you sort of increased the position was Springfield Property. Do you want to explain what was driving that?
Very, very much so. Yeah, MPAC was probably it's not a long list of businesses that were a kind of net winner from the budget.
Yeah,
and that's because they design automated robotic packaging lines for big businesses.
Yeah.
2 weeks ago, businesses in the UK just had a big reason to buy more MPAC things and not hire people to put things in boxes.
Yeah.
Sadly, and half of their revenues are in the US. I think you want US earnings exposure, not the multiples, but the earnings. With the UK valuation, I think that's quite a good way to play the next 18 months. So that's a very quick answer to that. Springfield Properties, start with value, the price you pay. It's the cheapest house builder on the London market, but it's got some of the most interesting prospects. And by that, I mean it owns a massive bank of land with planning permission. In fact, they've been selling some of that down recently at a profit just to monetize into demand. And actually, some of that land they still own and haven't sold is around where the Scottish Freeport is going in and the Green Power Line. And there's sort of thousands of homes have to be built to service that investment by the government. So we think it shouldn't be the cheapest house builder on the market. Probably shouldn't trade at the premium either, but it's on, I think, 0.65 or 0.7 times book value at the moment. House builders typically trade at 1.2, and if things are looking really rosy, which obviously they're not at the moment, maybe a little bit higher. So you can see just on valuation grounds there's decent upside. But actually, this Scottish Freeport opportunity is a kind of decade-long plus.
Yeah.
So we see it as a cheap house builder to buy, and then perhaps hopefully when it does re-rate, can be a bit of a compounder going forward. So the reason to uprate it was we'd had more money in, and the stock was still attractively priced.
Yeah. Okay. Let's say I'm kind of closing out the interview. 2 things, I guess, I just wanted to get your sort of take on. One, I guess, framing risks and opportunities in, UK smaller companies. What do you want to see if you're going to meet a management team today to learn about the company, and you're thinking about risks and opportunities? What are you looking for? What are the things that you're looking for out of a management team?
First of all, straightforward. Tell me what your business does, why it makes money, in a way that I can draw it with a crayon afterwards.
Yeah.
And, actually, that's quite a skill, and not many management teams do it.
Yeah.
And that's important for 2 reasons, or maybe even 3. One is you have to understand something to be able to price it. And a fund manager's job is to price something, provide a discount to that price, and sell it hopefully at a premium, but certainly part. And so if a business is complicated, you're going uphill from the start. And if the management team can't even communicate that, well, then how the hell are you as a third party external to the business supposed to do that? So that's the first point. And then really a sense of belief over the long term, how they're going to create value for shareholders. And that's usually a mix of, we're in this market and it has these attractive attributes, and here's our strategy to go and capture a slice of that for you, or hopefully you, the shareholders. As a first meeting, if you can get those three things covered, that's a good first meeting. Very rarely do we come away going, I understand the business, the strategy is really clear, and this is what we need to go and look at the market. But that's what we look for initially. Then you it's like a bit of a Russian doll. You go layers in beyond that. And yeah, that's how I would describe it.
Okay. So basically, be clear about what you do and how you earn money. Okay.
Yeah. Why do you have a margin?
Yeah.
Turnover is vanity.
Yeah.
Why do you command a profit? Why will people pay you for what you do?
Yeah. Okay. I can imagine it's been a fascinating, and like all journeys, not without it's sort of ups and downs since you launched Onward Opportunity. I mean, I do remember, that sort of. I was really happy that actually, I knew when you were sort of marketing the IPO in a very tough market, they actually got it away. I was just sort of really delighted to hear that success story. Love to hear from you, sort of, if you had to pick one moment from this journey since you launched the fund to tell people about the story of Onward Opportunities, story of Laurence Hulse, what would it be?
I'm almost tempted to pick a bad moment, a kind of high and a low.
Yeah.
We'll start with the low so we can finish on a high. Yeah, this very year it nearly didn't happen.
Yeah.
Like really nearly.
Yeah.
Like money you might kind of win on a scratch card was the difference between getting over the minimum and not. And there was a moment where the penny dropped that a lot of people had been telling us it couldn't be done, they won't do it. It's barking mad, not just brave. And there was a moment very close to when the IPO, but was supposed to, I think, even maybe the day of this kind of soft close where everyone had to give their verbal commitments. Silicon Valley Bank went. And when you're already it's already really hard trying to raise money, something like that just spooks investors. And that, I tend to take things in my stride as an individual. I'm quite sort of happy-go-lucky in some ways. But that was one of the few times I felt my stomach turn.
Yeah.
I'd left a job where I had some fantastic friends and colleagues and had been there from the start and was, had good prospects to do this because I believe in it. And I knew the same reasons why it was going to be so hard were the same reasons that if we could launch, we'd be delivering the returns we are now. Because the drivers of a tough market are the drivers of cheap shares. But at that moment, I thought, I've blown it. I'm going to be, it's beans on toast forever. And it, but I had some really great colleagues around me at Dowgate and on the investment committee who, we pulled through, and probably testament to what we aim to do going forward, that we did do it. Even when it was, really bleak with things like Silicon Valley. More positively, what that enabled us to do, we did get it away. We did what people said you couldn't do. And I don't think there's been a smaller companies fund really launched since. Definitely not a listed one, but I don't think even really a meaningful unit trust. And that was 18 months ago. But more positively, what's allowed us to do is find those gems amongst the rubble. And there was the first time, as an investor, I'm sure the listeners who buy stocks and will empathise here. Sometimes you just feel like it's just the kind of the beast is just coming into the crosshairs perfectly. The wind dies down, you got a clean shot. And we were doing the due diligence on MPAC and had just got that feeling that we'd found a kind of 3x. And those are hard to find by definition because if everyone knew they were 3x, they wouldn't be that cheap. We'd spotted the company on 2 of our 6 screens. it told us that change was going on in the P&L, the cash flows, and then we were getting to know the business. I think I came off a referencing call on the chief exec, a chap called Adam Holland, who is actually nearly literally a rocket scientist. I think he did astrophysics at Cambridge. We'd just come off the JCB referencing call, which is where I used to work, and it was glowing. And the sort of stars were aligning that we had a stock on like 2.5 times EBITDA. Really good kind of USP, use case and opportunity in the form of robotics and automation. Reshoring was even a thing back then. It definitely is now with the national insurance stuff and Trump. And you had timing, business model, people in place to execute. And if you can get those kind of right, it can make for a really good investment. I was lucky to witness some of those during my time at Gresham, Northbridge, Crestchit, Imi Mobile, Augean. I took witness colleagues get it right, and I knew this was one that was going to be right.
Yeah.
I thought, and it was that moment I thought this was worth it. In that, we can make this work. We can thank the shareholders who did just about get us there in that low point. We can thank them with good returns, differentiated returns, and the 15% per annum target we've been hitting and beating. That there's not many funds in any asset class, sort of long only, that we've been doing that. So we feel a bit blessed. We feel a bit lucky. We feel encouraged, and there's still gems out there and there's still rubble to forage amongst, and that's what after this we're going back to do.
Laurence, really, really huge pleasure to hear the story again.
Thank you.
Delighted for you and the progress you've made. Just the start of a journey, I think. So wishing you well, and we'll keep track of how things develop, and we'd love to get you back again to get an update as well. Laurence, thanks for being on Vantage.
Thank you very much.